In this video, I want to talk about what I've found to be what surprises business owners the most when they start investigating and looking into moving outside the US, or maybe they're an expat and have already moved outside the US. Specifically, this is the Qualified Business Income Deduction, or QBI, or Section 199 Cap A. This deduction has a very interesting impact on moving outside the US or international investments, where it may not apply anymore if you move, or you have to do some very specific planning on the front end to make sure that it does continue to apply. So that's what we're going to talk about in this video. I'm going to talk about some specific client examples that I've had and that I've worked through in my business, and how we can to better predict how the QBI deduction is going to apply in your scenario if you move outside the US, and helping you bolster some support to make sure it still does apply and you get the best of both worlds, which may be the Foreign Earned Income Exclusion and QBI. My name's Alex McGowan, owner of McGowan Tax, where we provide practical international tax solutions for small businesses and individuals. So first, I want to talk about what the QBI deduction is, a little bit of its history, what the rules are, how it applies, and then we'll talk about specifically the impact that I see it has on businesses and business owners that move outside the US. And then we'll talk about the practical takeaways and solutions to make sure that you're at least not surprised if something doesn't work the same way, or that you're supporting a position to continue to take the QBI deduction. So the Qualified Business Income Deduction came about as part of the Tax Cuts and Jobs Act in 2018. And specifically, it was provided to appease the flow-through entity businesses out there. So prior to 2018, you had a different tax rate structure that we were working with. You had a corporate tax rate that was at 35% and an individual tax rate that was like 39.5%. So much higher tax rates. The big thing that the Tax Cuts and Jobs Act did is it dropped the corporate tax rate down to 21% from 35%. So now you have these businesses that used to be flow-through entities. So think about S corporations, your partnerships, sole proprietorships. They're now potentially taxed at 39.5%, whereas the corporation's taxed at 21%. If you left it like that, we would have seen a huge shift in people switching their businesses to C corporations. It would have been a huge administrative hassle for a lot of people, and just not a fair way to compare different types of businesses. So what the IRS did, or Congress, to try to equalize that treatment, was they came up with this Qualified Business Income Deduction. So what it is a 20% deduction for flow-through type businesses against the qualified business income. So the net income of that trade or business, essentially. So that 20% deduction applies across the board to qualified businesses, and to be a qualified business essentially really applies to the net income of any flow-through entity. But there are thresholds and limitations, of course, that the IRS have built in that apply in certain circumstances. If you're liking this video, you should really check out my newsletter, where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice. So the QBI deduction applies really to any flow-through type entity. So that's your partnerships, your S corps, your sole proprietorships. But there are, of course, limitations that the IRS has put in place and certain thresholds. So once you've crossed over into a certain amount of income, there's two different things you need to look out for. One is if you're a specified service trader business, you actually can't take the deduction at all. And that's businesses that are really just consulting type businesses, where you're operating off the know-how of the owner. And the classic example, and what they were carving out for some reason, was people like me, accountants, consultants, lawyers, those type of people. Once you cross that income threshold, which is about $400,000 for a joint filing, if it's a specified service trader business, you can't take this deduction anymore. If it's not a specified service trader business and you've crossed that threshold, now you also have to apply limitations based on the wages or fixed assets of the business. Generally, what you're looking at is you're limited by 50% of the wages paid by this company. So if it's a sole proprietorship or really an S corporation and you're the only employee, your QBI deduction, that 20% of the net income, is limited to 50% of the wages you pay yourself. So that's one of the balancing acts that you're working with in designing a plan for the QBI deduction. But most businesses are already well aware of this at this point. So you've been operating, and people have been operating under this QBI regime for a long time now, since 2018. Now all of a sudden people are calling me and they're wanting to to move abroad. And they're assuming that this QBI deduction is going to continue to apply. The other requirement for qualifying for this deduction is that the income has to be effectively connected with a U.S. trade or business. Now, the definition of that is not so clear, of course, in the IRS and the Internal Revenue Code, but we have to apply the case law that's available to determine if that apply or how that rule applies for businesses. It's very obvious, right? If you live in the U.S., if you have an office in the U.S., you're doing your work here, you have a U.S. trade or business. But all of a sudden, if you move outside the U.S., the question is, what was left in the U.S. and is that actually a U.S. trade or business? So the way that I work through it and the way you have to think about it is, if this was a foreign person, so think if you're the owner of this business and you're trying to see if you still qualify for the QBI deduction, you have to assume you're a foreign person and you're doing business in the U.S. Would your business qualify as a U.S. trade or business? The typical example that trips most people up is if you're a consultant and you don't have any employees, you have no physical presence in the U.S., no contractors or building or office in the U.S., and you just pack up, take your laptop and move to Costa Rica, then there's really nothing left in the U.S. other than potentially an LLC or an S corporation, or maybe it's just a sole proprietorship. In that case, it's going to be very hard to argue that you have a U.S. trade or business. So in those cases, you're probably going to miss out on the QBI deduction. Now, you may get the added benefit of the Foreign Earned Income Exclusion, which is a good trade-off between the two. But you need to factor in the fact that you're no longer going to have that QBI deduction, and that surprises a lot of business owners. So one thing you can do for that, I recently had an example of a client where they had an S corporation in the US. He moved to Europe. He's the owner, sole owner of that S corporation. His business worked around staffing solutions. So he had a lot of contractors in the US that he would put at different jobs in physical locations in the US. So they would go work at a job site, but they were contractors for his business. In that case, we did an analysis of his company to ensure that he was going to meet the threshold for the QBI deduction because of the presence he still kept in the US. So he tripped that rule for having a US trade or business and income effectively connected with that trade or business. However, there was still foreign source income because he's the owner of that business and earning income. So it creates a weird dynamic, especially if you're eligible for the Foreign Earned Income Exclusion. So you're still performing services in your capacity as the owner and a service provider for that business outside the US. So that's foreign sourced income. But this business is also still in the US doing work there. You have contractors there, and that's effectively connected income to that US trade or business. So in that case, we were able to support the argument that he got the best of both worlds. He got the Foreign Earned Income Exclusion with respect to his salary from the S corporation. He also got the qualified business income deduction with respect to the business that's going on still in the US. And we had to play with that limitation on the W-2. So it came out to a pretty complicated algebra problem at the end of the day of the W-2 limitation, the Foreign Earned Income Exclusion, the qualified business income deduction. But the first step was making sure he qualified for all of these. And then we have to play with where does he get the best bang for his buck? Where do we balance the scales on one deduction versus the other? So that was a specific example where we were able to get over that line of still being eligible for the qualified business deduction. But in a lot of cases, if you have nothing left in the US, it's going to be very unlikely where you can still take the qualified business income deduction. So the takeaway is, if you're a business owner and you're currently enjoying the qualified business deduction and you're looking to move outside the US, in preparation of that, estimating your income and taxes going forward, you need to take into account potentially not having that deduction going forward. Are you eligible for the Foreign Earned Income Exclusion to offset what you're losing there? And is there enough still in the US to where we could still claim both and get the best of both worlds? Or is there a way we can even plan into intentionally leaving enough in the US so that we can get the qualified business deduction and the Foreign Earned Income Exclusion? If you're a business owner and you're looking at moving abroad, or maybe you already live outside the US and you're wondering how these different deductions can apply and how you take the most benefit of each one and balance that correctly, feel free to look us up on our website, schedule a consultation with me directly, and we'll have a call and do a cross-border tax diagnosis one-on-one.